You've probably heard you need a 20% deposit before you can buy your first home, but that's actually not true. Hey, I'm Maryanne Elliott from 360 Mortgage Solutions, and today I wanted to talk about all the various deposit options you have as a first home buyer. So let's start with the perfect world. Yes, absolutely. In a perfect world, if you are able to save or you have got a 20% deposit plus costs, you'll be able to buy your first home, assuming you can afford the repayments on that new mortgage. But the reality is, most people can't afford to save 20% of their purchase price. If you're looking at $1 million, which in today's market is not a fancy home at all, you are looking at a $200,000 deposit plus costs just to get that deposit. That's huge. And most of the first home buyers I see simply can't save that much or don't have that much. So what other options are there out there? So to begin with, there's the lender's mortgage insurance option. So if you don't qualify for one of the schemes, we can still borrow with a smaller deposit, but the bank will add some lender's mortgage insurance onto your loan. Effectively, that's like, think of it like a car insurance policy to protect your loan, but rather than the bank paying for that insurance policy, they on-charge it to you because you haven't had that 20% deposit. Another option is with guarantors. And honestly, being a first home buyer specialist, I see this all the time. Parents might have a property, even if they've got a mortgage against it currently, that they have lots of equity in and they want to help their kids get into the market. This is a beautiful way without them having to physically put their hand in their pocket. There are some caveats or some things that you need to be mindful of when it comes to guarantors because, of course, there are risks. And so that's something that we would discuss at length with the guarantors before they signed anything. So they're your two most common, or they were the two most common before the government schemes came out. Now we have some schemes which allow first home buyers to get into the market with a 5% deposit plus costs, and that 5% deposit will have no lender's mortgage insurance. How can the lenders do this? It's because the government is going guarantor on the loan instead. So rather than having a parent go guarantor, rather than having to pay an insurance policy, the government has says if this home purchase goes bad and the applicants default on the loan and the bank loses money, the government will reimburse that shortage. So that gives the lenders quite some comfort, and they're happy to then do the loan at a lower deposit without any lender's mortgage insurance in place. There's another option which is becoming more and more common. And to be honest with you, it was the type of scheme I never thought that I would write. However, the more I researched it and the more I've seen it work with clients, and I have had some clients use the scheme to purchase their first home, it is proving to be quite a good niche for certain applicants, and that is the Help to Buy scheme. So with a 2% deposit plus costs, you can get into your first home, or you can get into a subsequent home if you've been kicked out of the market, say gone through a divorce, or you sold a few years ago and you can't get back in. And the government will lend you the cash to finish the purchase. So let's say you can only borrow a certain amount, but you need a little bit extra to get you into the market. The government will chip in effectively and buy into a portion of your property. Now, I've heard quite a few clients in the past, and I myself thought the same, was the comments were, I don't want to buy a house with the government. And the beautiful thing I like about this scheme is that you can effectively buy the government out at any point in whole or in 5% increments. So I work really closely with my clients that are on this scheme and that are considering this scheme to make sure that there's capacity in their budget to make extra repayments to the mortgage, with the long-term plan of buying the government out in 5% increments. I have also had clients say, if I was to buy with the government, so let's say I buy $1 million property with the government has a 30% share of that property and I haven't bought them out. Well, that means when I go to sell, the government still has a 30% share in whatever equity or growth that property has had in the market. And that's absolutely true. But in my head, you're still getting 70% of some growth and getting into the market with the opportunity of buying the government out in those 5% increments so you can own the property entirely. Or you don't get into the market at all, you never own, and you never have something, 70% of the equity growth of something. So as I said before, it is a case by case. It's absolutely not for everybody. but it is helping quite a few of my clients to get into the market in the first place or to get back into the market because we know borrowing capacity is really tight and the property prices are really high. So I guess the moral of the story is you absolutely don't need a 20% deposit to get into the market, but you absolutely do need to talk to a first home buyer mortgage broker specialist who can guide you through the different schemes, the different grants, and everything that you might be eligible for so that you can see what you can do and then make some decisions based on that. So guys, other than that, that's it from me. I hope you have a fantastic week and I'll catch you next time.